So what about this bond sell-off? I mean, we're seeing it around the world, it feels like right now.
So we are, and I think this morning, especially comments from the ECB were not necessarily helpful, or at least certain members. But what we're looking at as far as the bond sell-off is after a relentless flattening, at least in 2017, potentially a steepening and underperformance of the long end of the curve, particularly the 10-year sector. So that's what our rate strategists are looking at least on the equities side. I think the real question is when does that actually spill over, especially given the fact that if you think about the cost of equity, of course, it's essentially the 10-year yield plus that equity risk premium. And what does that mean for the market? Well, I think we're starting to see signs of that this morning. So far, all the way up to 270, we didn't necessarily have too much sensitivity. Now, we saw weakness in the utility sector. We saw some softness in the staples sector. But, finally, I think we're starting to see a broad market decline, at least on the back of those higher yields.
How can you want to be a seller of equities in an earnings season that has been incredibly strong?
So that's a great question. I think part of that has to do with the fact that the market has priced in so much of this earnings season. So if you look at the S&P year to date, up about 5% relative to earnings expectations for the year, only up 2%. So if you think about earnings for 2018, yes, the market is pricing in a stronger year. Well, what does that actually mean for 2019 and 2020? And when is the next recession going to be? Now, if bond yields continue to go higher, the Fed continues to hike, well, earnings can only grow for so many quarters until we do get that next recession. So on that basis, how much can the market rally from here?